So here we are again. The markets are roaring, the bulls are charging, and everyone is hyped. We've got headlines buzzing about a fresh bull market rally, Trump winning the 2024 election, and the ARP trades sending stocks into orbit. You can feel it, that electrical thrill sweeping through trading groups and crypto circles, that collective hope of making that one move, that one investment that changes everything for you, your whole life. Everyone's chasing that rush, that dream of rocketing wealth before you can even blink. Hey, what's up, lads? Your digital guide here, obsessively leading you through the labyrinth of fast money dreams, market euphoria, and most importantly, financial hype. But let's pause there for a second. The obsession with getting rich overnight. Yeah, it's speaking again, especially in this time with the bull market. We're bombarded with the same old stories, guaranteed investments, moonshot trades, and the get rich quick schemes that promises to have you swimming in cash. But why are we so hooked on these fantasies? Why do we keep believing them over and over again? And what happens when the hype train inevitably derails and reality hits hard? So that's basically what we are going to tackle today. We're going to dive deep into the psychology behind the hype and how these schemes reels in, what happens when the bubble bursts and the dust settles. And if you want to keep this conversation going, my free Discord is open. Links down in the description and also in my bio. Yeah, so alright, let's kick things off, with a phrase that perfectly captures the vibe of these wealth markets that are going on right now. And you've probably heard it, it's to the moon. No, again, to the moon. Yeah, okay, so you have heard it probably on Twitter, crypto groups, stock trading chats, maybe even shout it yourself when a ticker started surging. But where did this phrase actually come from and why does it get us so hyped? Well, to go back, we need to go 3 years prior to today. It basically really blew up into 2021 during the GameStop madness. For the people who didn't know, the GameStop madness began in the Reddit crew at Wall Street's bets and took GameStop on a meme stock roller coaster. And To the Moon became the rallying cry. And also Dogecoin jumped on board and suddenly everything was on a rocket to the moon. But here's the thing though, those moon rides, they barely stay in orbit. Most of these wild climbs end with a crash landing, a big crash landing. And the adrenaline is fun while it lasts, but when reality hits, not everyone walks away a winner. It's just a small percentage who came in early that basically wins. So let's break down how this hype works on Twitter with the meme coins and some trending sectors like the AI sector, for example, and why it's so damn tempting, and also what happens when the ride ends. So let's pull back the curtain of financial frenzies and see how the madness really works. From classic pump and dump schemes to the FOMO driven chaos, there's a whole playbook for these scams, and they know exactly how to mess with our brains. You've probably heard of pump and dump schemes. They're the bread and butter of financial scams, and here's how it goes down. So, a group of insiders find an asset or make a meme coin, usually some obscure stock or a freshly minted cryptocurrency with low trading volume, and decide to blow it up. So they enter the big hype machine, like social media platforms, influencers with way too much enthusiasm, and maybe even a celeb endorsement or two. The buzz hits hard, and suddenly the narrative is this is the next big thing. And the whole secret sauce on top of it is urgency. They're gonna hit you with stuff like act now or don't get left behind. And they'll throw around charts that show early spikes, sprinkle in some testimonials from supposedly savvy investors, and drop wild predictions about insane gains like this is gonna go to the moon 15x or maybe even 100x. It's too good to be true. But as more people buy in, the price shoots up, and for a minute it feels like you've got a one-way ticket to the moon. But here's the twist though. You remember the insiders we talked about in the beginning? They were never planning to stick around. The second the price hits peak hype, they pull the rug, dump their holdings, and walk away with a bag full of cash. And what's left is a nosediving price and a bunch of latecomers clutching worthless investments. And if you didn't cash out in time, well, you're gonna order back, but it's not gonna be a designer one. For example, let's talk about a scam that went down in the textbook fashion, the Squid Game crypto coin from 2021. Riding the hype wave of the Netflix phenomenon, this token promised users a play-to-earn game that sounded like the next big thing. Social media went nuts, and the price, it shot up from pennies to over $2,800 in days. I mean in days. And everyone was hyped, everyone was ready to cash in. But you could have already cashed it. The developers hit the eject button, like on a PS3. They cashed out everything and disappeared into the void. Investors were left holding a token that was worth absolutely nothing. The hype train derailed hard, I mean really hard. They went to the left from the rail, they crashed, I don't know. And it was a perfect storm of hype, FOMO, and cultural obsession. A classic textbook pump and dump dressed up as a revolutionary opportunity 101. These scams aren't just random accidents, they're calculated plays on human psychology. So, next time you see something going to the moon, take a step back and ask yourself, who's really fueling this rocket? Make sure that you do your own research. Now, while pump and dump schemes are full on scams, hype-driven speculation is something different. It's more subtle and more insidious, and it preys on our desire to be part of something big. FOMO, as you call it. Social media, viral memes, and influencer endorsements weave together a story so enticing that even the most rational investors abandon caution, diving in purely on the wave of momentum. And one of the most striking examples of this was the GameStop saga in 2021. What started as a struggling retailer stock on the brink of collapse turned into a global phenomenon thanks to the subreddit Wall Street Bets community. And this wasn't just speculation, it was about rebellion and a movement fueled by memes and a shared goal to beat Wall Street at its own game. GameStop stock had been heavily shorted by hedge funds, and the Wall Street Bet group saw an opportunity to trigger a short squeeze by banding together and buying in loads of GameStop shares. They forced hedge funds to cover their position at skyrocketing prices, driving the stock even higher. Mainstream media coverage and figures like Elon Musk amplified the frenzy, turning GameStop into the ultimate meme stock. But as the chaos reached its peak, Robinhood, an exchange where you can trade stocks, controversially stepped in, removing the option to buy GameStop shares and allowing only sales, a move they attributed to liquidity issues. Although that's what they say, this meant that retail traders couldn't drive the price even higher, effectively halting the momentum. The decision sparked widespread outrage, with many accusing Robinhood of protecting institutional investors at the expense of regular traders. Regulatory investigations followed, and the incident raised serious questions about the fairness in the financial system. And when the dust was settled, the result was the same as with most hybrid speculation. The stock plummeted and latecomers were left holding the bag. Unlike pump and dump schemes, Orchestrated by insiders, this was a story of group psychology in overdrive, amplified by the power of social media. Everyone was buying in because everyone was buying in, until the hype inevitably faded. The fear of missing out, aka FOMO, is a powerful psychological driver that scammers and opportunists exploit mercilessly. It's the feeling you get when you see your social media feed flooded with posts about others make life-changing money. You know those gurus? Anyway, those gurus, you start to wonder, what if I miss my chance to be part out of this? FOMO thrives on urgency and exclusivity. Phrases like limited time opportunity or only a few spots left create a sense of scarcity, pushing people to act before they can fully assess the risks. The emotional appeal often drowns out the rational thinking, leading to impulsive decisions. And another key factor in speculative bubbles is the bandwagon effect, the tendency to do something simply because others are doing it. Social proof is a powerful motivator, and when you see thousands or even millions of people buying into an asset, it creates the illusion that it must be a good investment. Like social media platforms amplify this phenomenon with viral posts, trending hashtags, and community driven hype cycles, creating a feedback loop. As more people jump on board, the hype snowballs, attracting even more participants. And at the core of these scams and speculative bubbles is a chilling truth: they're fueled by manipulation. Whether it's influencers hyping a coin they secretly plan to sell, or communities rallying around a meme stock, the mechanics are designed to exploit human behavior. The combination of FOMO, the bandwagon effect, and social media's reach creates a perfect storm. And while some early participants walk away with huge profits, the majority are left grappling with losses, financial and emotional. And as we've seen, the mechanics of hype and manipulation are often at play, whether in speculative bubbles or outright scams. Behind the bright lights, catchy memes, and celebrity endorsements, the truth is often far darker than it seems. FTX, for instance, wasn't just another success story in the crypto space. It was the epitome of how manipulation can fuel growth and convince millions to buy into an illusion. FTX was a crypto exchange that had a lot of potential for what the future of finance could be, led by its charismatic founder Sam Bankman-Fried, aka Sam the Scam. The platform had all the makings of a once-in-a-generation success story. FTX was a cryptocurrency exchange that aimed to revolutionize the way of how digital assets were traded. It offered a range of services including spot trading, futures, and derivatives, catering to both retail and institutional investors. And FTX was known for its user-friendly platform and advanced features, making it popular among crypto enthusiasts. It also ventured into traditional finance with the creation of FTX US for United States users and became involved in various high-profile partnerships and sponsorships, boosting its credibility and visibility in the space. Celebrities like Tom Brady and Larry David were on board, throwing their weight behind FTX. Big marketing campaigns, promises of low fees, and revolutionary new trading features made it seem like FTX was the place to be if you wanted to be part of the next wave of finance. And at one point, FTX was even valued at a staggering $32 billion. But you could have guessed it already. It was unfortunately a story too good to be true. The success of FTX wasn't built on solid financial fundamentals. It was basically a house of cards. On the surface, FTX appeared to be the golden child of crypto exchanges, a shining example of success in the otherwise volatile and unpredictable world of cryptocurrency. It had major endorsements from celebrities like Tom Brady and influencers promoting it as a future of finance. But behind the curtain, things were a lot darker. FTX's entire business model was based on risky practices and deceptive financial strategies. And one of the most glaring examples was how FTX took customer deposits and funneled them into its sister companies, Alameda Research. a trading firm run by Sam Bankman-Fried and his inner circle. And instead of safeguarding user funds like any legitimate exchange would, FTX was using its customers' money to make speculative bets and cover the mounting losses at Alameda Research. For instance, FTX used customer funds to fund high-risk trades in volatile cryptocurrencies like Solana, for example, hoping that the price would go up to cover the losses somewhere else. This wasn't just reckless, it was downright fraudulent and terrible. When things started to go wrong at Alameda Research, FTX got continued to promise these users that their funds were safe and that the company was financially stable. But as crypto prices started to fluctuate and the loss piled up, FTX couldn't keep up anymore, and in late 2022, the whole house of cards came crashing down. The crypto community started to get wind of FTX's shaky financials when leaked documents showed a huge gap between the platform's liabilities and assets. And once the news broke, a run on the bank ensued. Customers rushed to withdraw their funds, but FTX didn't have the reserves to back up their promises. For example, one user tried to withdraw over $500,000 in Bitcoin but couldn't get it. And when Binance, a major player in the crypto space, announced it was pulling out of a potential acquisition deal, the floodgates opened, and within days, FTX filed for bankruptcy, leaving billions of dollars of customer funds missing. It was a catastrophic collapse that shook the entire cryptocurrency industry, eroding trust in what many thought was one of the most secure exchanges. FTX was a cautionary tale in the crypto world. Just because a company looks successful, has celebrity backers, and runs flashy marketing campaigns doesn't mean it's trustworthy. And before putting your own money anywhere, it's important to take a deep dive into how the company operates, who's behind it, and what kind of financial practices they're using. In the crypto world, the risks are often greater than they appear, and FTX is a prime example of what happens when hype and celebrity endorsements cloud sound business practices. And so in May 2022, things started to unravel. A panic sell-off in the market caused Terra USD to lose its dollar peg, and as confidence in the system evaporated, people started burning their Terra USD to create Luna in droves. This flooded the market with Luna, which caused the price of Luna to plummet from around $100 to fractions of a cent in a matter of days. In total, $60 billion in value evaporated almost overnight. This collapse wasn't just a crypto blip, it reverberated throughout the entire market, triggering a cascade of losses for individual investors and institutional players alike. The systemic failure was massive, and the impact is still felt in the industry today. But why did it actually fail? Well, the first thing is the over-reliance on trust. The entire system depended on faith in the algorithm. As long as people trusted that their USD would maintain its peg, everything would be fine. But once confidence shattered, the whole house came down. Without a safety net or real-world assets backing the token, the algorithmic model couldn't save it. The second thing is complexity. The mechanics of the system were complicated and difficult for the average investor to understand. Most people didn't fully grasp how Terra USD and Luna were connected, and when things started to go wrong, there was no real way for the average person to fix it. In crypto, complexity can be dangerous. And last but not least, number 3 is market instability. The broader crypto downturn in 2022 only exacerbated the problem. The market was already in a bearish trend when Luna and Terra USD started to crack. It only sped up the collapse, and the whole system was too fragile to withstand external pressures. The Luna USD collapse was a harsh reminder that stablecoins, especially algorithmic ones, are not as stable as they seem. Even the most innovative ideas can fail when there's too much reliance on speculation and trust in an untested system. And look, if you don't understand how an investment works, be really cautious and always do your own research and invest with what you can invest. Don't throw your life savings in anything. Algorithmic stablecoins may sound innovative, but the promises of Stability often masks significant risks. Why does this keep happening? Well, the allure of easy money is hard to resist. People see others getting rich quick and think, why not me? Add in the hype, and it's a perfect storm for bad decisions. But the thing is, true sustainable wealth doesn't come from chasing trends or speculative bubbles. It comes from taking a smart, steady approach to your money. Even if you have secured the hype and came out as a winner, how are you gonna sustain and keep that wealth? So, here's how you can protect and avoid becoming someone else's payday. The first one is learn the basics of how money and investment works. Understanding the game helps you play smarter. And before you invest, dig into the details. Don't blindly follow a group on X, aka Twitter, who hype up a crypto coin or a stock or whatever. Know what you're putting your money into and why the project or coin is a good idea. The third one is if everyone is talking about the next big thing, it already isn't the next big thing anymore. Most of the time, you might gonna be the exit liquidity. Take a step back and analyze the thing. Hype often hides risk, and instead of trying to make a quick buck, focus on building a diversified portfolio over time. Slow and steady wins the race. The bottom line, don't let the promise of easy wealth blind you to the risks. Stay informed, stay grounded, and you will be less likely to end up footing the bill for someone else's success. And that's it. Thanks for hanging out today. If you've got thoughts or experiences with these schemes, drop a comment down below. And don't forget to like and share this video to help others. Avoid the pitfalls of get rich quick schemes. And hey, I'll catch you in the next one. Remember, when it comes to wealth, there's no such thing as a free ride.